Welcome to the research desk.
Glad to be diving into this one. It's quite a turning point for us.
It really is. Imagine, for a second, building a flawless financial machine, a system engineered to strip away human emotion.
Right, the ultimate objective algorithm.
Exactly. To peer through the fog of market panic and, perfectly navigate the economic chaos of the last decade. We spent years analyzing the architecture of this machine, which we call the arbitrage hedge framework.
And at the macro level, it was brilliant.
It was an absolute triumph. We pointed it at the vast universe of global asset classes, so equities, sovereign bonds, commodities, and gold. This was our Layer 1 analysis.
Yeah, and at Layer 1, the numbers are just pristine.
They really are. It systematically dismantled risk parity strategies. It humiliated the classic 60-40 portfolio. From 2016 to 2024, it delivered a pristine 0.94 Sharpe ratio.
Capturing the upside while actively shielding capital during global sell-offs.
Which is the holy grail. It worked because it relied on the closest thing finance has to a universal law, mean reversion. The logic is elegant, really. You score assets based on relative value and hedge demand.
Right. You buy what is structurally out of favor and bleeding capital.
Yes. And you sell what is dangerously crowded and priced for perfection. Because what is expensive must eventually come down. Capital is finite, and expectations always eventually collide with reality.
The math at that cross-asset level is completely airtight. But today we arrive at a very dramatic turning point.
We do. Because we have to discuss what happens when you take this exact same flawless machine, keep the logic identical, and simply turn its lens inward.
And what happens is absolute devastation.
Wow, okay. Devastation?
Absolute devastation. The expectation, of course, was perfect continuity. The assumption was that if this elegant logic holds true between broad asset classes, it must hold true between the individual sectors that make up the S&P 500.
Right, what we call Layer 2.
Exactly. You take the identical scoring system, the identical philosophy of buying the cheap and selling the expensive, and you point it at technology, consumer staples, industrials, financials.
Just zooming in the microscope.
Right. But when you apply cross-asset logic to equity sectors, the engine explodes. The model breaks down so completely that it forces us to question the entire foundation of contrarian investing.
That seems a bit harsh, doesn't it?
The numbers are harsh. We go from a world-class 0.94 Sharpe ratio down to a dismal 0.52.
Ouch.
Yeah. We go from outperforming sophisticated benchmarks to lagging the simple, unglamorous, capitalization-weighted S&P 500 by an existential margin.
An existential margin?
We are talking about a catastrophic 7.8 percentage point annual bleed.
That is a massive drag.
It is. This is not a slight tracking error that you can explain away in a quarterly letter to clients. This is the kind of systemic, structural failure that ends careers.
Well, and that catastrophic failure creates the central tension we have to resolve today. Because I represent the contrarian philosophy in this analysis, and I refuse to believe that the underlying physics of capital allocation simply vanish.
Just because you change the zoom level?
Exactly. Gravity does not stop working just because you look at a smaller object. The S&P 500 is not a monolith.
No, it's definitely not.
It is a living, breathing ecosystem of sectors that wax and wane. They move based on economic cycles, regulatory environments, consumer behavior.
Sure, there is internal rotation.
Right. So the framework that successfully beat the smartest all-weather portfolios in the world over a remarkably turbulent decade, I might add, does not suddenly become invalid. It doesn't break just because we are looking at technology versus utilities instead of equities versus gold.
But the empirical reality of the data says otherwise.
Now look, I will concede that the day-to-day pain of watching a concentrated market run higher while you sit in defensive sectors is real. The emotional toll is massive.
It's agonizing.
It is. But the entire purpose of a contrarian risk management framework is to protect you when the structural illusions of the market finally shatter.
Assuming they shatter.
They always do. As we will explore, the brutal market events of 2022 completely vindicate this model. It did exactly what it was built to do, exactly when it mattered most.
Well, I represent the brutal empirical reality of the data today. And the data tells a deeply uncomfortable story for the contrarian philosophy. Layer 2 is emphatically not Layer 1.
You don't buy the physics analogy?
Not at all. We cannot wave away the math of existential failure by appealing to universal laws of physics. Financial markets are not physics.
What are they then?
They are human constructs, and they are governed by structural trends. Using the exact same architecture that worked for cross-asset allocation, this sector model builds a portfolio that commits financial suicide.
Financial suicide is a strong praise.
It's the accurate phrase. The data proves that contrarian investing at the sector level is not a universal law. It is a regime-dependent observation.
Okay, explain that.
When you apply this philosophy indiscriminately across an equity market that is dominated by a structural, fundamentally justified trend, you are not engaging in risk management. You are standing on the tracks in front of a freight train.
Armed with the belief in pendulum swinging back.
Exactly. Armed with nothing but a theoretical belief. The underperformance is so severe and so deeply embedded in the mechanics of the strategy that it renders the contrarian sector model structurally flawed.
Then let us lay out exactly what that structural flaw looks like on paper. I know the top-line numbers are, well, they're difficult to digest for anyone who builds systematic portfolios.
Difficult to digest is an understatement. Let me walk you through the reality of the numbers, and I really want the sheer gravity of this gap to sink in.
Go for it. Lay it out.
From 2016 to 2024, if you ran the arbitrage rotation strategy at Layer 2 shifting capital between sectors based on relative value, you delivered a compound annual growth rate of 7.2%.
Okay, 7.2%. Not negative, at least.
Sure, but imagine you did absolutely nothing. Imagine you completely abandoned active management, required zero intellectual effort, and simply bought the capitalization-weighted S&P 500 index.
Just blind passive indexing.
Exactly. That passive strategy delivered 15.0% over the exact same time frame. You are surrendering nearly 8 full percentage points of return every single year, compounding.
That is a very tough pill to swallow.
It gets worse. The Sharpe ratio, which is the ultimate measure of how much return you are actually generating for the risk you're forcing your investors to take, is effectively cut in half.
Right, so let's hear the Sharpe numbers.
The simple passive index gives you a pristine Sharpe of 1.00. The mathematically complex, hyper-sophisticated arbitrage strategy gives you a 0.52.
And the counter-argument here is always going to focus on the downside protection. I mean, the Sharpe ratio measures volatility, but contrarian investors care primarily about the maximum drawdown.
They want to survive the crash.
Precisely. We design these systems to avoid the catastrophic loss of capital. That's the whole point.
But that is exactly where the math gets genuinely terrifying. The maximum drawdown, the one metric this strategy is specifically engineered to protect against, is actually worse.
Wait, really? Worse than the broad market?
Yes. During this period, the passive S&P 500 suffered a maximum drawdown of negative 23.9%. The arbitrage strategy, which theoretically positioned you defensively when things got expensive, suffered a negative 27.0% drawdown.
Wow. So you lose on the upside and you lose harder on the downside.
To put that into perspective, even a pure momentum strategy, a system that blindly buys whatever is already going up, completely ignoring valuations, suffered a maximum drawdown of only negative 17.9%.
Okay, that is a glaring failure.
Right? How does a sophisticated rotation strategy yield half the risk-adjusted return of a passive index, while simultaneously subjecting the investor to a deeper absolute loss than a momentum portfolio?
It's a fair question.
The model fails on every conceivable metric. It does not generate alpha, it does not reduce volatility, and it does not protect the downside.
I hear the severity of those numbers. I really do. But we have to question the nature of the benchmark you are using to declare this an existential failure.
The S&P 500 is the standard benchmark.
It is, but we need to be very clear about what that index actually is right now. You are measuring the model against the capitalization-weighted S&P 500. It is not a neutral, objective arbiter of the broad equity market.
How so?
The cap-weighted S&P 500 is essentially an aggressive momentum strategy in disguise. The mechanics of the index dictate that as the largest companies grow larger, their weight in the index increases automatically.
Well, sure, because their market cap is expanding.
Right, so you are blindly buying more of whatever is most expensive. Over the last decade, that index morphed into a highly concentrated, levered bet on a handful of megacap technology stocks.
It concentrated heavily, yes.
If you want to evaluate whether the mechanics of rotation and mean reversion are broken, you have to look at a neutral baseline. Look at the equal weight S&P 500 index.
Okay, let's look at it.
When you measure the broad democratic performance of the 500 largest companies in America, you see a very different picture. The equal weight index also struggled immensely during this era.
It definitely lagged the cap-weighted version.
Severely. It posted only a 12.2% compound annual growth rate, a 0.76 Sharpe ratio, and a severe negative 26.7% maximum drawdown.
Okay, but it still beat the arbitrage strategy's 7.2%.
It did, but the gap is much narrower. The model's failure against the cap-weighted index does not necessarily prove the contrarian philosophy is broken.
What does it prove then?
It forces us to ask a much deeper question. Does this performance simply reflect the highly anomalous historical decade where the fundamental concept of diversification itself was punished by an irrational market?
Calling a decade-long, fundamentally driven structural trend an irrational anomaly is the ultimate comfort blanket for a failing strategy.
You don't think a decade can be an anomaly?
Not when it's driven by real cash flows. That excuse is what portfolio managers tell themselves when the market refuses to validate their models. The broad underperformance of the equal weight index is not an excuse. It is exactly the point.
How so?
It connects directly to the specific mechanism of the failure. The model collapsed because it was assigned a mathematically impossible task.
Which was?
Underweighting a structural juggernaut that was fundamentally reshaping the global economy. To really understand the depth of this failure, you have to step out of the theoretical data and step into the shoes of a portfolio manager who actually has to live through this catastrophe.
All right, let's walk through the psychology of it.
Imagine the psychological torture of running this model year after year. Let us look at the technology sector. In the S&P 500, technology makes up roughly 32% of the benchmark.
A massive chunk.
Because these companies have incredibly strong price momentum and trade at high valuation multiples, the contrarian model algorithmically identifies them as dangerous. It flags them as an overcrowded trade.
Because traditionally, they would be.
Right. So the rules of the system demand that you aggressively cut your technology exposure. You have to take your weight from the benchmark's 32% down to a mere 2%.
Let me pause you there because the listener might be thinking something very specific. If a sector is severely overvalued and dominating a third of the index, isn't cutting exposure to 2% exactly what a disciplined risk manager should do?
In theory, maybe.
Why is taking a defensive posture considered a death sentence?
It is a death sentence because of the brutal math of tracking error. Let us translate that 2% weight into reality. Let's look at 2020.
The pandemic year?
Exactly. In 2020, the technology sector posts a return of positive 43.9%. This is driven by a massive, fundamentally real shift to remote work and cloud computing.
A huge macro shift.
Yes, and because you are holding 2%, while your benchmark holds roughly 28% at that time, you are not just missing out on gains. That single algorithmic decision creates an annual performance drag of negative 11.0 percentage points against your benchmark.
Negative 11 points from one sector.
You spot the market in an 11-point head start, but it gets worse. Let's jump to 2023. Driven by the absolute explosion of artificial intelligence, the technology sector posts a staggering positive 56.4% return.
Unprecedented growth.
Your benchmark weight is now 30%. Your model weight is still locked at 2%. Your annual drag for that single year is negative 15.8 percentage points.
That is brutal.
And we aren't done. In 2024, the sector posts another positive 36.6%, creating another negative 11.0 percentage point drag. Picture the reality of sitting in a quarterly review with an institutional client.
trying to explain those numbers.
Exactly. The most powerful wealth creation engine in modern financial history is compounding relentlessly higher, fundamentally backed by trillions of dollars in real corporate earnings and cash flow.
And you own none of it.
None of it. And your model forces you to stand aside, hold deeply underperforming defensive stocks like consumer staples, and explain why losing your clients 15 percentage points a year is actually brilliant risk management.
It is the agony of being right in theoretical valuation, but devastatingly wrong in practical reality.
No professional investor can survive a 16-point drag from a single sector and retain their sanity, let alone their career.
Well, what you are describing as agony, a disciplined risk manager recognizes as the necessary cost of survival.
Survival? You're bleeding out.
Hear me out. You are focusing entirely on the upside momentum of technology while completely ignoring the return distribution asymmetry that the model is desperately trying to navigate.
Okay, explain the asymmetry.
Let us look closely at those returns you just cited. The excess returns generated by technology over the broad market are massive, and they are incredibly frequent. We see excess returns of positive 30.2%, positive 25.6%, and positive 18.9% in individual years.
They are massive, yes.
Now, contrast that with the assets the model rotates into, like consumer staples or utilities. Those defensive sectors only offer small, infrequent bumps of positive 5.8% or positive 4.7% against the benchmark.
Exactly, they barely move the needle.
But that's the point. When you look at that dynamic objectively, technology's historical 3.9% annual outperformance over 7 of the last 9 years looks exactly like late-stage concentration risk.
You think it's a bubble?
The market is pricing in absolute permanent perfection for a single sector. The model is not broken. It is executing a mathematically necessary protocol against an asset class that has temporarily disconnected from fundamental gravity.
Temporarily disconnected for a decade?
Yes, macro cycles can run long. The Contrarian framework is explicitly designed to subject you to the emotional discomfort of small, rare wins against the benchmark during bull markets.
Which is a very hard sell.
It is, but you pay that price specifically to protect capital from the massive, devastating losses that inevitably occur when a crowded trade violently unwinds.
That defense rests on a massive assumption, though.
What assumption?
It assumes the environment we are operating in, the internal ecosystem of the S&P 500, actually allows for that kind of risk management. It does not.
Why wouldn't it?
To understand why, we have to deeply analyze the structural differences between cross-asset allocation and sector rotation. We have identified 3 specific preconditions that must exist for a contrarian, mean-reverting strategy to succeed.
The 3 preconditions?
Exactly. Why does a spectacular 0.94 Sharpe ratio drop to a dismal 0.52? The answer is structural. Layer 1, the cross-asset world, meets all 3 of these conditions perfectly. Layer 2, the sector world, meets absolutely none of them.
Then let us break down that architecture. The first fundamental precondition for any contrarian strategy to work is the requirement that expensiveness must be temporary, not structural.
Right. Temporary expensiveness.
And in layer 1 in the cross-asset world, this condition holds perfectly. Think about the mechanics of broad asset classes. No single asset class can maintain absolute leadership for more than 2 or 3 years without triggering a macroeconomic reaction.
The system self-corrects.
Always. Equities go on a massive multi-year run. Valuations stretch, inflation builds, and eventually the business cycle turns. Central banks raise rates and equities fall.
And then bonds rally.
Exactly. Or perhaps inflation spikes due to a supply shock, and commodities take the lead. Gold has its specific moment in the sun during periods of monetary debasement or severe geopolitical panic.
True, the leadership constantly rotates.
So in this cross-asset environment, when an asset screens as expensive in our model, it carries a very specific piece of information. It means the asset is at a cyclical peak.
It's stretched too far.
Right. It means the economic pendulum has swung as far as it can possibly go, and the reversion to the mean is mathematically imminent. The logic holds beautifully.
But when you apply that exact same logic to layer 2, the condition completely fails.
You're saying technology isn't cyclical.
I'm saying technology is not experiencing a cyclical peak, it is riding a multi-decade structural trend. It is growing at a structural premium of 3.9% per year above the rest of the market.
But eventually,
In this specific regime, being expensive in technology is simply the new equilibrium. The sector commands a permanent premium because these companies generate unprecedented free cash flow, they operate with marginal costs near zero, and they effectively dominate global infrastructure.
they are fundamentally different businesses.
Exactly. Furthermore, the fundamental information content of the word cheap changes drastically between the two layers.
How so?
Well, at layer 1, when an asset class like commodities is cheap, it means it has suffered cyclical underperformance. Capital expenditure has dried up, supply constraints are quietly building, and it is a coiled spring ready to release the moment demand returns.
A classic value play.
But at layer 2, within the equity market, when a sector is consistently cheap, it almost never means a coiled spring. It usually indicates structural terminal decline.
Value traps.
Yes. Think about what screens as cheap in the S&P 500 today. A cheap regional bank, weighed down by commercial real estate loans, or a cheap legacy telecommunications company carrying massive debt. That is not a value opportunity. It is a value trap.
And the model can't tell the difference?
The contrarian model mechanically buys these dying sectors, blindly expecting them to revert to the mean, while simultaneously selling the structural winners that are actively redefining the global economy.
Okay, that brings us to the second precondition, which deals directly with how that reversion actually happens. It is the nature of the catalyst.
Right, the trigger for the reversion.
Because even if you believe an asset is severely overvalued, valuation alone is rarely enough to force a price down. You need a catalyst. The true genius of cross-asset rotation in layer 1 is that the catalysts driving the reversion are automatic, and they are entirely exogenous to the business cycle.
They happen outside the control of corporate earnings.
Exactly. Consider gold. We have global central banks systematically buying roughly 1,100 tons of gold a year to diversify their sovereign reserves away from the US dollar. That creates a persistent structural floor under the asset that has nothing to do with consumer spending.
And commodities work similarly.
Right. OPEC enforces production cuts regardless of what the S&P 500 is doing. If oil drops too low, they constrict supply, forcing the price back up. And consider equities. Every 2 weeks, millions of workers automatically pour portions of their paychecks into 401k plans.
Constant price-insensitive buying.
Yes, it creates hundreds of billions of dollars of blind flows annually. These massive forces act as automatic stabilizers. They trigger mean reversion independently of the broader economic mood. You don't need to predict a recession to know that central banks will buy gold or 401ks will buy stocks.
And once again, when you look at layer 2, sectors fail this condition completely. Sector catalysts are not exogenous. They are deeply endogenous.
Meaning they rely on the macro environment?
They are entirely dependent on the macroeconomic cycle cooperating with your portfolio positioning. Let us go back to that cheap industrial sector or that cheap material stock your model just bought.
Okay.
For those cyclical sectors to recover and actually reward the contrarian investor for taking the risk, they require explicit macroeconomic expansion. A cheap industrial stock cannot magically rally just because its price-to-earnings ratio is low.
It needs actual growth.
It requires a tangible reacceleration in global manufacturing. It needs rising purchasing manager indices, expanding corporate credit, and strong consumer demand. If the macro environment does not provide that specific expansionary catalyst, cheap stays cheap indefinitely.
You're stuck in a dead money trade.
Precisely. The contrarian model at the sector level is essentially making a massive, unhedged bet on an imminent and highly specific change in the macroeconomic cycle.
And if the cycle doesn't change?
When that macroeconomic change does not arrive, when we get a slow growth environment where only mega-cap tech can generate earnings, the portfolio is left holding deeply out of favor, dying assets with absolutely no structural force available to lift them.
You are painting a picture of total structural failure. But let me challenge the mechanics of how much damage that actually causes. Even if a sector stays cheap, why is the penalty so severe?
That leads exactly into the third precondition, which is the ultimate punchline of the structural argument. It is the concept of concentration asymmetry, and it explains why the penalty is lethal.
Let's hear it.
For a contrarian strategy to survive being early, because contrarians are always early,
The cost of underweighting the market leader must be strictly bounded.
Bounded risk.
At Layer 1, the cross-asset portfolio is fundamentally equal weight in its architecture. The maximum weight of any single asset class is naturally bounded, typically capped around 11%.
Right, you can't go to zero on a 50% position.
Exactly. If the model incorrectly identifies gold as expensive and violently underweights it to zero, the absolute maximum pain you can suffer relative to your benchmark is bounded by that 11% ceiling.
It acts like a referee in a boxing ring.
That's a great way to put it. You can afford to be wrong. You can afford to sit there and wait for the mean reversion to happen, because the tracking error is mathematically capped. It does not destroy your portfolio.
But at Layer 2?
Layer 2 is not a boxing ring with a referee. It is a street fight against a giant. The mathematics of the cap-weighted S&P 500 make survival impossible. Technology is 32% of the benchmark.
So the math is just entirely different.
When the model demands you underweight it to 2%, you are voluntarily opening up 30 percentage points of tracking error against the most powerful momentum vehicle on Earth. The cost is entirely unbounded.
It's just massive exposure.
To make matters mathematically worse, you fall straight into the correlation trap.
Explain the trap.
In cross-asset allocation, you benefit from genuine diversification. The correlation between gold and the S&P 500 is historically roughly 0.05. The correlation between long-duration U.S. Treasuries and the S&P 500 is historically around negative 0.30.
So they actually act as hedges.
When equities fall, bonds and gold provide a genuine structural hiding place. They actually go up. But sector correlations offer absolutely no refuge.
Because they are all equities.
Exactly. The correlation between the technology sector and the broader S&P 500 is an overwhelming 0.95. Technology literally drives the index. Even the sectors you hide in, like consumer staples, run at a 0.65 correlation to the broad market.
Everything moves together.
You cannot hide inside the equity market. When you underweight the 32% behemoth, you are not engaging in risk management. You're simply taking on massive, unhedged benchmark risk without acquiring a single genuine diversification benefit.
I have listened to you detail the structural failure, the unbounded mathematics, and the agonizing emotional pain of the portfolio manager suffering through the years between 2016 and 2024.
It's a bleak picture.
And your logic is sound if you assume the market paradigm of the last decade is permanent, but you are describing a bull market illusion.
An illusion?
Yes. We have to address the moment the illusion shattered. We have to look at the year 2022. This is the year that stress tests the core architecture of everything we are debating right now.
2022 was certainly a shock to the system.
We all know what happened. The global economy experienced a violent regime shift. The era of free money ended. Inflation spiked to generational highs, central banks panicked and raised interest rates at the fastest pace in modern financial history.
And tech got crushed.
Yes, the structural juggernaut of technology that you have been praising suddenly collided with gravity. The capitalization-weighted S&P 500 crashed, falling a brutal negative 18.2%. The technology sector was absolutely decimated as valuation multiples collapsed.
It was a painful correction.
But what happened to the arbitrage rotation strategy at Layer 2? What happened to the system that you claim commits financial suicide?
It performed.
It posted a positive 6.8% return. Let that sink in. While the rest of the market was drowning in double-digit losses, while passive investors were watching years of wealth evaporate, this model generated positive absolute returns.
It was a very impressive spread.
That is a massive positive 25.0 percentage point outperformance in a single devastating year. So I pose a direct challenge to your empirical reality.
All right, let's hear it.
When a mathematical system is explicitly designed to protect capital against regime shifts, and it flawlessly delivers a 25-point save during a global market meltdown, does that not fundamentally validate the architecture? Is this not the exact moment the contrarian model proves its worth?
It's a compelling narrative, I'll admit.
The model was not broken. It accurately recognized the historic overvaluation in tech. It correctly identified the lethal concentration risk in the benchmark. It methodically moved the portfolio into defensive postures, And it completely saved the investor from a catastrophic drawdown.
I will pause and fully acknowledge the triumph of 2022. It is impossible to deny. It was a spectacular, almost flawless navigational achievement by the model.
Thank you.
For 12 months, the portfolio manager running that system felt like a genius. They felt entirely vindicated. The strategy did exactly what it was engineered to do in a crisis, shielding capital while the world burned.
Because mean reversion eventually wins.
But we must immediately reframe that single year of glory against the larger, inescapable timeline of the data. You're asking if a 25-point save validates the architecture. I ask you, does one glorious year of vindication redeem 8 years of systematic, agonizing bleeding?
I mean, if it saves the portfolio.
The mathematical answer, unequivocally, is no. The cumulative, multi-year math is uncompromising. If you bleed 8 percentage points a year for 7 years during the expansion, a single 25-point save during the contraction does not make you whole.
You're still behind the benchmark, overall.
You are drastically behind. The model subjects the investor to an incredibly toxic psychological profile, small, rare wins and large, frequent losses.
It is definitely contrarian in the purest sense.
You are forcing the investor to pay an exorbitant, compounding premium in the form of massive underperformance during the expansion years just to buy an insurance policy that pays out for the 1 year the market collapses.
But that insurance is necessary.
Not at that cost. 2022 is not a validation of the framework. It is the exception that proves the rule of Layer 2 failure. It confirms that the contrarian sector strategy only works in a highly specific, highly destructive macroeconomic regime, a rapid rate hiking cycle, and fails completely and systematically in all others.
Well, we have reached a profound, almost philosophical impasse. I look at the complete data set incorporating the salvation of 2022, and I maintain that the underlying physics of mean reversion are fully intact. The engine works. The model is structurally sound.
Even with the massive underperformance.
Yes, because the problem we are analyzing is not a flaw in the logic. The problem is the unprecedented duration of the current macro regime. Fighting structural winners like modern technology requires a level of extreme, multi-year patience that most professional investors, driven by quarterly performance reviews, simply do not possess.
That's true. Institutional patience is very low.
The 2022 stress test mathematically proves that when the structural illusion ends, when the free money stops, the contrarian architecture is the only thing standing between an investor and catastrophic loss. We are knowingly sacrificing yield today to ensure absolute survival tomorrow.
And I look at the exact same data set, the exact same returns, and conclude that applying Layer 1 logic to Layer 2 ignores inescapable mathematical realities.
You just can't get past the unbounded cost.
You simply cannot build a functional portfolio that ignores the unbounded weight costs of a 32% benchmark constituent. You cannot algorithmically and blindly sell structural trends in the name of mean reversion when the economic catalysts required for that reversion simply do not exist organically within the equity market.
It's a completely different battlefield.
Exactly. The failure of this system is not a matter of a lack of patience. It is a matter of profound structural misdiagnosis. You are applying the physics of the solar system to the quantum level and wondering why the equations break.
There is, however, a partial solution found in the deepest layers of our source material, which we must acknowledge to complete this analysis.
The hybrid approach?
Yes. The data outlines a concept called the regime adaptive hybrid. This adaptation attempts to directly fix the second precondition we discussed, the catalyst condition. By overlaying a macroeconomic regime filter onto the model, the system stops blindly buying cheap sectors during contractionary environments.
Which prevents it from buying into those value traps.
Right. If the macro data shows the economy is slowing, the model recognizes that cheap cyclical sectors have no catalyst to recover, and it refuses to buy them. This hybrid approach significantly boosts the historical performance, bringing the Sharpe ratio back up to a 1.06, finally exceeding the passive cap-weighted benchmark.
It is a genuinely critical adjustment to the model, but we must be clear-eyed about its limitations.
It doesn't fix everything.
No, it doesn't. The regime adaptive hybrid solves the catalyst problem by preventing the model from stepping into value traps during recessions. but the most fundamental issues we discussed remain completely unresolved.
The structural winners and the tracking error.
Exactly. It does absolutely nothing to solve the first precondition regarding structural winners versus cyclical peaks. And more importantly, it does nothing to solve the third precondition regarding unbounded weight costs.
You're still forced to sell tech.
Even with the macro filter, you are still mathematically forced to take massive, unhedged tracking error against a 32% technology sector whenever the model deems it expensive. You are still, fundamentally and structurally, fighting the dominant, cash-generating force in the modern equity market.
Which leaves us pondering the ultimate question of this entire analysis. Is the classical philosophy of contrarian investing, the idea that you buy the fearful and sell the greedy, dead?
Or just severely limited?
Or does it simply require strict, uncompromising boundary conditions? Does it demand the equal weighting and the automatic exogenous catalysts of the cross-asset world? Because modern, highly concentrated equity sectors can no longer satisfy the math.
It's a question that forces you to rethink risk entirely.
It really does. We have pushed the arbitrage framework to its absolute breaking point today, demonstrating exactly where and why the gears of mean reversion shatter. But the mechanics of how we rebuild risk management in a structurally concentrated world will require even deeper diagnosis.
This is the Research Desk officially signing off.